Welcome back to First Business this morning. Well, the Reserve Bank of Australia's rate decision yesterday was, of course, expected. The statement that came was pretty similar to what we've had in previous months. One of the main differences, though, it seemed in the Reserve Bank statement was the comment on where the globe, or how the globe is looking at the moment. One particular comment caught our attention, that volatility in many financial prices is currently unusually low. That was a statement from the Reserve Bank that has been added from the previous statement. The mention, and I suppose you could say the concern suggested there, seems to echo some, well, stronger warnings really from other leading central bankers lately. We've seen the Bank of England's Deputy Governor say the lack of volatility is eerily reminiscent of the run-up to the financial crisis in 07-08. Italy's central bank governor has talked about the levels at the moment in the past sometimes being preceded by rapid changes in the orientation of investors. These kinds of warnings starting to come through, and again we see today low volatility. Larry Shover's Chief Investment Officer at SFG Alternatives joins us now. Great to have you on board. Thank you so much, Larry Shover. It was a Brown Brothers Harriman report I was reading this morning that called this low volatility quite mysterious. It's one of the quandaries of the market at the moment. Why do you think this is happening?
Well, first of all, I think we shouldn't overthink it. I mean, you're correct. No matter if you look at rate vol, FX vol, metals, everything, volatility is low. What it means to me is that we're healing as a world. I mean, our data is getting better. No matter where you look at it, emerging markets are getting better. China is growing, although from a high base. U.S. is growing, et cetera. So is this indicative of another crash? I mean, I think that's rear view mirror investing. I mean, we can have this kind of low volatility for a very long extended period of time before we have any type of correction. That's how I look at it.
We've heard it was a Dallas Fed chief, Richard Fisher. He's saying it's an accident waiting to happen. He said, in fact, people are taking risks that they shouldn't be. They're far too complacent. What makes you so confident?
Well, what makes me confident is that I think the other side of that argument is very heavy. A lot of people think that people assume just because the volatility is so cheap that something bad is going to happen. Well, eventually we're going to have a 10% correction. It's just timing it is a different story. And we don't have enough back data to suggest that any kind of implied volatility is a good indicator of what's going to happen tomorrow or next week.
Do we want volatility to return, though? I mean, I guess at the moment we're kind of searching for catalysts. If it's not a bad thing to have low volatility, is it a better thing to have that volatility return?
Well, yeah, it's a great point. As an investor, you want low volatility. I mean, we could be in a repeat of 1994, 2004, where we just sit here and bake for 6 to 12 months. There's nothing wrong with that. On the other hand, the men and women behind me, they want high volatility. They want divergence in trends so they can capture momentum. So it's depending on who you talk to. I prefer a little bit of both.
Larry, can I ask you about the big events this week? Because, again, just kind of going to the volatility argument, some are saying finally, you know, if we get an ECB move, something maybe out of the ordinary, you get a big move on the jobs numbers in the US on Friday, we could see things kind of really shaken up again. Let's go to the ECB in particular. You've said, actually, unfortunately, this could be anti-climactic. I've seen people say it could be the biggest event of the year, so that would be a huge disappointment.
Yeah, I do think it will. I mean, it's been minced, it's been sliced, it's been diced. I mean, I think the bottom line is I think Draghi is going to underwhelm because let's keep this in mind. The Bumblebee speech happened 2 summers ago when people were trying to rescue the euro. Right now, that's not the case. It's going to be more technical, less ambitious to maybe manufacture inflation, cause risky behavior in financial assets. I don't think it has anything to do with trying to save the euro. So I think people are just, their memories are just far, far too short. I mean, is there a chance that he could do something big? You know, absolutely, but I think the odds are very, very small.
Yeah, let's go to how it suits expectations then. Is it a bad thing if we don't get some kind of big bazooka announcement, or can he guide market expectations effectively towards the end of the year, say, for something bigger?
Yeah, no, that's good. I think a knee-jerk reaction is always the wrong one. It takes a while to digest the news. I think the best-case scenario is that you'll see yields in Europe and also here in the U.S. rise a little bit on whatever he has to say. So disappointing news doesn't have to be bad news. It just gets one more catalyst out of the way.
Larry, any other events you can see as that, potentially could return us to what I think you've described as more normal trading patterns, i.e. a bit more volatility?
Yeah, well, I mean, maybe the jobs report we have in the U.S. on Friday, we're modeling 218,000 as a 6.4 unemployment rate. But what people really are watching underneath the surface is really wage inflation. We need to have a little bit of that. Last month, it was unchanged month on month. We're calling for about a 0.2 increase on the month, and that's going to be an important catalyst and could change the narrative.